Hey, what's going on, guys? So in this video, I wanted to answer some questions that I've had from the Drippy community, and hopefully these answers would help you out and help you level up your DeFi skills. And let's dive right in here. So a lot of questions have been talking about some hedging LPs, about DCing some Bitcoin or on Ethereum. How do we actually go about doing so in the best way possible? And how can we actually earn yield in the process as well? And the first question I want to go over is using a hedge LP setup. I've recently made a video on that. And let's use the Drippy tool here for the simulation. I've already set this up, but I can redo it so that you know how to set it up yourself. But basically, if we start with 100K, and I'm just using 100K as an example, right? You could use $1,000, $10,000. The actual amount does not matter that much. What matters is maybe you're just using a portion of your portfolio for this, because there are some advantages with a hedge LP and some disadvantages as well. And currently ETH is trading at around $2,000, and it could be higher and lower than that, but I'm just using a round number to make things simple. And let's just say you want to set your min price to be 1,000 to 3,000. And I do have a position that has this exact range, and it is pulling about like 25 to 30% APR right now. So that's a pretty solid APR. At the same time, if we simulate our performance here and prices do drop towards the bottom of our range, we are standing to lose about 37% of our capital, 37K. And on the upside, we are standing to gain about 8K of our capital. But this is not a big deal if your goal is to get more cash flow and you believe that ETH is going to trade above $2,000 in the future. Then it's fine to suffer through this drawdown and then kind of ride the trend upwards, right? But let's just say you want to throw on a hedge because the downside seems like it's too much. And when throwing on a hedge, you're going to be giving up some upside as well. So what I want to do here is click on the short button. And then what I want to see here is how much ETH I hold, right? And for a tighter range LP, I generally like to start with like about half of the ETH capital here that I have on the screen. So I have about 19 ETH, and let me expand the screen a little bit. So here you can see I hold about 38% of ETH here, because the range is like a plus and minus 50% ETH. It's not going to be 50-50 ratio because of the way the math works. And what I want to do is start with half. So it was 19 ETH. Maybe I could start with 9 ETH, right? And what I like to do is if I want to set a stop loss, because this is a tighter range LP, I don't want to keep the LP open or the short open as the LP got out of range, right? Because you can see here, if I keep the short open and I'm out of range for the LP, I'm not earning any yield and I'm actually losing more and more money on the short. So I don't want to keep the short open. Maybe I want to rebalance my position at this $3,000 mark. So I could set a stop loss here at 3K, or it could be slightly below your range as well. But what I want to make sure is I want to make sure that I'm not losing that much money on the stop loss. I personally don't like to lose any money at all at the stop loss. And the reason why is if you just entered into a position and prices just hop to 3K right away, then you could easily lose money and you just would have been better off just not doing anything at all. So I like to have like a break even at the stop loss. So what I want to do, because I am losing some money, I could dial down the short to 8 ETH. And then you can see I would be gaining a little bit of money here. So that is fine. Or I could bump that up to 8.5. And then what I want to do now is I could set a take profit simulation as well. Let's just say I want to set the take profit at $1,000 for the short. And our calculator would calculate right away that, okay, at this stop loss level, you will be gaining about $156. And then at the take profit level, you will be losing about 28K. And this percentage number is accounting for the margin that you put in. And if I don't want to put in 17K, I could increase the leverage to 1.5x. And you can see here, the liquidation point is still above my stop loss. And that's what I want, because if the liquidation point is below the stop loss, then you're going to be liquidated before you get stopped out. So the reason why we have a stop loss in place is because we could kind of exit our positions a little bit earlier. We don't have to wait for liquidation. And again, it just doesn't make sense to keep it open if you're closing your LP position at the top of the range. And what I want to emphasize here is the trade-off, right? You can see this is basically the profit and loss beforehand that you had earlier. So if we did not do a hedge and prices go to upper range, we would have 8K worth of gains in capital gains. And then the bottom side would be 37K. But now with the hedge, the bottom side has reduced pretty significantly to about 28, 29K. That's a pretty big reduction, especially because the drawdown is quite aggressive all the way to $1,000. Is it possible that ETH gets all the way there? Definitely, right? We got around there during the last bear market, and that could always happen. But basically, it depends on what you prefer, right? If you prefer to have less downside, then you could throw on the hedge, and it's going to allow you to take less risk with the LP. And this does work because it's wide enough to stay in range for a while. If we just look at the chart, $1,000 to $3,000 wide range, especially during the bear market where the activity is kind of low, maybe we're going to be able to stay in range for even like a year or two, right? Of course, we never know if prices reverse all the way to the upside. That's also fine because you don't want to put your entire capital into this hedge setup, because if you do, then you're severely capping your upside. So you want to kind of use only a portion of your portfolio for this type of setup, maybe like your stablecoin allocation. You could have a portion of it into this so that you're kind of lowering your volatility of your portfolio if you do prefer to have a less volatile portfolio, right? And the way I would manage this position is, let's say the price goes all the way up here, then you want to just let the stop loss trigger, and then you want to exit your LP. And you could use a automation tool like VFAT to exit into USDC at this $3,000 mark, or you could exit slightly earlier just in case that the liquidity is kind of different from the purse platform that you are hedging from, right? And when you're hedging, you want to make sure that you have enough liquidity on the purse platform that you choose, either like the major exchanges that are more reputable, or you can use stuff like Hyperliquid to short, and then you could use the VFAT to set an exit here at 3K. And then at the bottom side, I could exit as well, but instead of exiting to USDC, I would probably exit to ETH here at the bottom to kind of just buy more ETH at the bottom, right? Because if I only lose 28K, 29K, while ETH is drawn down by 50%, I can actually buy much more ETH than if I were to deploy all of my capital at $2,000 right now, right? And of course, we never know what's going to happen in the future, where we're going to bottom out. You could always rebalance to a bullish range when, let's say, the price is at 1500. We could run the simulation. Price is at 1500. You can see you're down only about 9K, even though the price has drawn down pretty aggressive already, 20 something percent. You could decide to rebalance to a more bullish range. And so with this type of setup, you could look to gain about like 20 to 30% APR on your capital, which is pretty good, especially for the risk that you're taking. But here's how you're going to get into trouble when you're trying to hedge, right? Let's say instead of setting a wide enough range, you go for like an 1800 here to $2,200 range. So this is a very tight range here. If I drop down to daily chart, if you're using the daily chart to set your ranges, you're probably setting your ranges too tight. Let's say you set your range at 2200 to 1800, right? This is actually very, very tight, right? And some people do this and they would advertise you a really high APR, right? And this is how you could actually get into trouble. We could start the whole process again. Here you can see I'm actually holding a bit more ETH here, 23 ETH. And let's just say I want to start with 10 ETH a short, right? And then now, because the ranges are quite tight, I do need to set my stop to be tighter at 2200. Maybe my take profit is at the bottom of range here at 1800, right? You can see at take profit, I'm only gaining a little bit of money. I'm not losing any money. So that is a good sign. But then the take profit, I am losing some money here and I am locking in some losses. And at the initial glance, it might look really good, right? Because you could see like, okay, I'm not losing that much money when I get to the take profit level at the bottom here. And then I'm also not losing any money here at the stop loss. That is also a partial hedge. But the problem comes when like, okay, the prices is trending and it's not moving the way that you expect it to. And you never know like how long the price is going to grind at these levels. But the main downside with that type of position is it's very hard to manage like, okay, when should I actually close my position and when should I re-enter? Because on the same day, you could actually, let's say, go down here, you're actually losing the capital, you close your position. And then if you close all the way to ETH, right, all of your capital into ETH, then if prices keep drawing down on that same few days, then it's very hard to, okay, decide what to do. You're out of range. And then you got to rebalance into a new range. And if you do close into a USDC and price do bounce back, price always could wick down below and then bounce right back up how it was doing back here, right? Price wick below. And after a few days, the price started bouncing back up. And if you're in USDC at that point in time and you did not re-enter into ETH or whatever, then you would have missed out on a lot of the upside and you're out of range as well. So you're not going to be earning any fees. So that is the risk with the bottom side. In any case, if you're getting stopped out or getting the take profit level hit, that's not a good thing. And then prices going down further is also not a great thing depending on how you're closing that bottom position. And if you're closing into USDC, sure, that's a good thing. But then again, right, if you close into USDC and price wick back up, then you kind of locked in that 4 or 5% loss. And then you kind of miss the upside as well, right? And then for the upside, you're facing the same issue where like, okay, your short is getting stopped out. And if you don't keep the short, the issue is if you just keep your LP without keeping the short, then if the LP kind of keeps going down, let's say it takes your stop out and then within the same day kind of wick back down, you're going to be losing some capital when that happens. And then you have to actually re-enter the short at possibly like a worse entry if that happens. And then it's just very, very hard to manage, right? And of course, it could always happen in the case where like it's taking out your stop and then shortly after it's kind of grinding down pretty aggressively. Of course, you could always reshort, but it's actually really tricky to manage in practice because let's say the price knocks out your stop and it's kind of bouncing around this level, right? Are you going to keep shorting or are you going to move up your stop loss? That is going to potentially incur even more losses. You're out of range once more. And so there's a lot of risk that goes into that type of strategy. And if you're squeezing the range like this, in my opinion, it's just way too tight. You're not going to be making much profit at all, if any at all, right? And if you do want to go for tighter ranges, it's kind of a gamble where you're trying to capture this type of price action where prices are kind of just bouncing between a zone. But even then, you have to kind of measure the zone, right? You can see here, it's around almost $1,000 wide range. So if your range is tighter than $1,000, then that's where you could get like stopped out and then your take profit levels could hit. And there's all sort of things that could happen, right? If you have been using perps or you've been around in crypto a while, sometimes the price on the perps platform did not match the price on chain, right? So there could be a scenario where there's scam wicks upward or downward where your stop loss is hitting and you're losing capital on the short and then you no longer have that short, but then your LP is actually not moving up in price. And then that is going to be locking in your profit, right? Having like a tight range also increase the risk for that. And especially on platforms, Binance, I believe there's much more of those things happening that could actually affect your profit and loss pretty significantly. Because you can see this stop loss is like you're losing 2 grand on a 100K. That is about like 2% loss on your LP capital if the loss got stopped out without the LP actually moving up in price. So that's another layer of risk to kind of consider, right? And let's go back to the previous example. I think it's much more sustainable. 3,000, right? And then the short was at 8.5, stop loss is at 3K, and then take profit is at 1K. And you can see here the math works, the concepts work. And the way I would manage again is if price goes up, I want to just use the USDC for something else. I wouldn't be like rebalancing up to kind of chase the range unless I want to do like a bidding LP, for example, right? And I've also been learning more about options lately. And what you will notice is that this equity curve actually has a profit and loss shape very similar to either a cash secured put or a covered call option. So I have not done too many option trades or sold or buy too many options, but if I were to, let's say, do a cash secured put on ETH, and let's just say I want to do 10 ETH worth, right? You can see this is the equity curve that looks very similar to what we have, right? The only difference is like at expiration, you will be profiting based on whatever premium that you collected. And the curve would not be as curved as that LP. And there are some risks associated with options. For example, if you sell a put option at $1,500, if prices dip below, then that's where you would be actually incurring some losses. But as long as prices stay above, you could earn whatever yield that you are getting from selling the option. And also there is another risk factor that we have to consider is if prices do reverse and is drifting up to, let's say, $2,500, right? You now have to sell a higher put option, take more risk compared to before to get the same yield. So if you're targeting like let's say 20% APR, you're probably going to be taking more and more risks if prices are kind of drifting upwards versus a hedge LP setup like this. Even if prices are kind of bouncing between $2,500 to $3,000, you are still going to be collecting about 20 to 30% APR, assuming that the APR stays around the same level where I've deployed my capital. So you're not going to be taking additional risk as prices kind of bounce up and down between this level, right? But the drawback with LPs is that you're not going to be getting your fees instantly versus for options, you will be getting the yield upfront. You're getting your option premium upfront. So that is a drawback with the LP. But at the same time, again, it all depends on how you want to structure your portfolio and how you want to use these tools. If you believe that the prices are going to kind of stay around these levels, then using a hedge LP like this is definitely a way to kind of handle that, right? And if you are setting a tight range anyway, it does kind of make sense to throw on some sort of a hedge if you want to protect your downside, because with a tighter range LP, your upside is not that much anyway. So the capital gains is typically not the goal if you are setting a range from, let's say, $1,000 to $3,000. So this is more of a cash flow position if you want to have that in your portfolio, if you want to prioritize cash flow with some of your positions, right? And doing something like this is safer than like doing this on maybe some other altcoins. But let me actually show you something that is actually really, really similar to a hedge LP. And the reason why I want to show you this is because you could actually get a very similar effect with a hedge LP by simply using a bidding LP or a bearish LP, right? Because when we're setting a bearish range, we are actually not buying that much assets compared to setting a bullish range. And what that allows us to do is to have a smaller drawdown compared to a bullish range LP. So let's just say I started again with 100K, and let me reset this here, and let's just say it was at 1,000 to 3,000, right? This is what we had. And I named this the bidding LP here. And this is a nice thing about the Drippy LP. You can name it, you can save it, and you can load these. You can see actually like what's the setting that you put for these setups. And basically what I want to do is I want to show you, okay, at the initial setup, if prices go to $1,000, you will be losing again 37K, right? But what if I move my min price all the way to zero? Prices move to 1K, like what we had before. You can see my drawdown would then be only 15%. So that is quite a significant improvement, even better than this hedge LP setup, right? But at the same time, because my range is wider, I will be earning less yield. We could use a tool like Revert Finance. And I know that this pool is actually one of the best pools that I am currently in. ETH USDC 0.01% on ETH mainnet here. So what I want to do is I could actually backtest this range. I put in 100K here on Revert. And then you could go to this create position tab to run this back test. But basically, I start from, let's say, zero minimum range or close to zero. And then again, max price is at 3K. There's a run back tester button here. And what I can see is this average total daily fees, right? I take 32.35, multiply by 365 to get the yearly yield. And you can see the yearly yield is about 11.8%, which is a huge improvement from stuff like lending your USDC or whatever, with the only caveat that, like, if prices do drop aggressively, you will lose a little bit of your capital. But at that point in time, that's not a big deal in my opinion, because at that point in time, you could just rebalance to a bullish range and capture a bunch more capital gains at that point. And that's probably what you want to do anyway. When assets are cheap, you want to just buy the assets rather than trying to over optimize the yield, right? But again, the yield is only 11, 12% for this setup. And I do know that with this setup, it's probably actually higher than this, because I've seen like the full range LP getting 10 to 12% in this particular pool. And because this is not a full range, this should actually have a higher APR than that, maybe 15%. So that's a pretty good risk and reward. But what I can do is, if I want to have the same exact hedge LP profit and loss and like the risk profile like this, where like at $1,000, I'm losing 28, 29K, I could bump up the min price, right? So the reason why I want to do that is because I would be earning more APR, but I'm taking more risk. Again, 500, let's say 600, that 650. So that is a little bit more. So 28.74K, and this is 28.77K, right? So 640 to 3K, you're going to have a very, very similar payoff curve compared to hedge LP. And we're actually gaining like 6% on the upside as well with the setup. So this is really nice. And you might ask, why would I want a, like a huge downside here if prices drop to like $1,000 and then you're losing 28%, but then you're gaining 6% on the upside, right? The answer is, if you're more conservative, you want to earn some cash flow, this is the way to do it. If you want more upside, we have to set a bullish range, right? And that is typically what I like to do if I don't care about my downside too much. If I believe that ETH is going to eventually trade above these levels anyway, I don't have to protect my capital that much. I just ignore the price action, keep DCAing into a bullish range, and I would have a much better performance. But this is for like, okay, if you want to use some leverage and you're taking out a loan and then you want to take less risk, because if you're like using leverage setup, you have to be worried about the potential larger drawdown, right? And you could kind of combine these strategies with the leverage setup to get the best risk and reward. But we could test the APR here for the range of that, what I just said, right? 640 to 3K. We will see a improvement on the fees that we earn. And here is about 60.47, multiply that by 365. So actually 22%, maybe even higher when we're actually putting it in practice, because sometimes the liquidity, if it's going down to downside, we're going to be gaining an elevated yield as well. And these are just estimates, right? We never know the actual yield. So it's about like 22%, slightly lower than what we had, but also a little bit more upside, less management. And another benefit is, if prices do dip below $1,000, you don't need to rebalance or do anything. You just sit tight until 640, right? Compared to this hedge LP setup, you kind of do need to rebalance. And then let's cover some other questions here. So the next question is about Bitcoin ETF and self-custody. So if we are self-custodying BTC, the drawback is just there's a learning curve to like learn how to store BTC safely, right? How to use a hardware wallet. But if you are kind of training your family, then that is like some time commitment you have to do. And you kind of want to maybe get them used to using those tools, right? One of our community members, Styles, was asking about this. He was saying he could write like a detailed instruction on his will to kind of teach the family how to access the funds. That is one way to do it. And You kind of want to teach your kids or teach your wife how to use these tools as well, making sure that they stay safe and train them on everything that I covered in the courses, like the safety, how to actually store the seed phrase, how to use a dedicated crypto device, and making sure that they're not doing any mistakes that could get them into trouble when you're storing that BTC, right? But at the same time, it could be actually really helpful to use a Bitcoin ETF. The main drawback with that is that, you're not storing the Bitcoin yourself. You've probably heard it hundreds of times, not your keys, not your coins, right? You're not actually storing the asset yourself. But that is kind of like buying paper gold, where you're not actually buying the actual gold, and then there's a custodian that buys the gold for you. And it all depends on your personal situation, because I do have clients that have a lot of money and they do buy ETFs rather than storing the Bitcoin themselves, because it is easier. And then maybe it's also safer for them to not carry that Bitcoin around or having to worry about securing that seed phrase. And then as they're getting older, also, maybe it's going to be easier to make mistakes when you're like interacting with crypto. I've made a huge mistake last year that costed me 76K. Even though I'm like really well versed to crypto already, I just got manipulated and social engineered, right? So that is also something to consider. And you could always do both. You could DCA a few Bitcoin ETFs. You don't have to use one custodian. That is probably the best way to do it. If you are using custodians, just use multiple custodians, because it's not as likely that every one of them are going to blow up at the same time. And if you do choose to move over, you could always sell and then rebuy Bitcoin. Of course, you got to worry about capital gains tax as well in that scenario. So I would try to kind of see if your family is suitable for like storing Bitcoin personally. But if they have actual no interest in like Bitcoin and they don't want to touch it, they think it's a scam, then maybe you don't want to kind of hold too much raw Bitcoin that you're planning to pass on to them. Maybe just keep selling some of it as the prices keep going up. You could use that to take profit into other assets that you could pass on to them if that is your estate planning goal, right? And of course, none of this is meant to be financial advice. I am just sharing what I think is the best thing to do. And I personally probably need to do that as well. I gotta write a document somewhere to kind of teach my significant other and my family how to access my funds in case there's something that happens to me, right? And for seed phrases, you could always, let's say, if you have a bank deposit box, you don't want to kind of put all of your seed phrase in one bank deposit box. You kind of want to split it into maybe 2 to 3 locations. That is another way to kind of store your seed phrase safely. Let's say you keep it in 3 separate banks or like in 3 different countries with different bank deposits, depending on if you have international banking or not. That is another way to kind of store your seed phrase. And then when you pass away, you can write a will where, okay, your family has access to the seed phrase and they know exactly where to get it and how to access those funds. And then you just write them a detailed instruction and maybe film a training video for them to make sure that they're not doing the security mistakes that could cost them their BTC, right? And there's some other questions as well. I think another main question that I do want to cover is, how do I actually earn yield while we're trying to buy more Bitcoin? So what I've actually found is that farming a lot of Bitcoin to USDC is not that great because the yield is not that great, and compared to stuff like E to USDC. So what we can do in that scenario is to use options instead of Bitcoin, especially because there's more liquidity for options for Bitcoin. And also because Bitcoin is still pretty volatile and the options premium is actually quite good. So one of our community members was asking in the Discord, like, okay, how do I set a limit order at 60K and then actually kind of earn yield in the process, right? I don't want to just set a limit order at 60K and then maybe wait for multiple months and then maybe the price doesn't hit, or and then I'm just not earning any yield in the process as well. Because if you're just lending your capital, you are putting that to work, but at the same time, you're not setting a limit order and you can't really buy that Bitcoin, right? So one option is to use options, and no pun intended. So this is actually a really popular strategy to accumulate an asset. Even Warren Buffett does it. He sells put options on a bunch of different stocks, and sometimes those put options are really, really long term. So you could collect more premium upfront to accumulate the assets that you want to accumulate anyway. But there's one thing to keep in mind with crypto options that is different from, let's say, stock options, is that a lot of these contracts are European style, meaning that if I sell a put option at 65K, the contract would actually not be relevant until the expiration date, right? So Bitcoin could actually do anything in between. Let's say Bitcoin drops to 10K, even though it's not likely, the option is not going to actually matter as long as it's kind of bouncing back and gaining some value back. But basically, if you are selling a put option, is you're actually obligated to buy that asset if prices dip below the strike price. So this is called a strike price. Currently, Bitcoin is at 66K right now, 67K. This is right below that. And you can see if you set a strike price that is really close to the current price, you are actually earning more yield, but at the same time, you are actually much more likely to get your order filled, right? If your goal is to get an order around this current price, then you definitely want to stick with like the option that is closer to the current price. And then you can see on March 27th, if Bitcoin is below 65K, I would receive zero point 0.15 BTC, right? I would basically take this 10,000 USDT to buy 0.15 BTC. And in this case, I am showing risk. Risk is a protocol on Hyper EVM, and UBTC is just a wrapped Bitcoin that is on Hyper EVM. So it's a different custodian. So there is a little bit more risk compared to, let's say, wrapped Bitcoin that is maybe have been around for a very long time. But you could also use like different option platforms like Derive or on centralized exchanges. I'm just showing you the concept, right? And if Bitcoin is above 65K, you just get whatever amount that you put for the option to be back. And you can see you can't really do like the whole amount. Sometimes you need to kind of round it up or round it down, and you would be earning about like 4% yield per month in this scenario, right? Because you are taking more risk with this particular option contract. And if you're trying to not get your order filled, then you want to sell option contracts that are kind of further away from the current price, right? Because Bitcoin to drop from 67K to 58K is not going to be as likely as Bitcoin dropping to, let's say, 64K or 63K. So this is why you will be earning less yield. And you're going to find that in DeFi, the higher the yield, the higher the risk that you're taking. And one thing about put options, though, is if prices do drift up, let's say Bitcoin drifts up to 80K, you're going to be having to sell your put options at a higher strike price to actually earn a yield that is comparable to what you're earning right here, right? The reason why you could actually earn really good yield right now is because Bitcoin is relatively cheap, in my opinion, at 67K. You could sell these put options at a really good price and then gain a pretty good yield. But again, if Bitcoin is trading at 100K, and you're selling put options at the strike price is 90K or 80K, that is a much different risk profile than what we're doing right now, right? Because getting filled right now, you're buying a Bitcoin at a cheaper price, and versus you're selling put options when prices are already quite high and maybe you don't want to buy that much, then you could just adjust the amount of puts that you sell. But this is just another way to kind of dollar cost average into the asset too. What I would do if you're trying to dollar cost average into an asset is you could choose a put option that is kind of closer to the strike price and also shorter in duration. So let's say you want to buy some Bitcoin in, and there is a size limit here on risk. So that is something to keep in mind. But what I could basically do is I could sell some put options at a strike price that is closer, and then I could collect some premium upfront, so $65 a premium, and then it's more likely that Bitcoin is gonna dip below 65K than if I'm selling put options that is all the way out here, right? If I'm dollar cost averaging. And if you have a specific target in mind, you could always sell at that point in time. And we could also use a platform like, let's say, Bybit. They have options. And what I want to do in this scenario is I could sell, again, a put option that is either a week or two out if I am trying to buy Bitcoin more aggressively, or if I want more active management, I could do that. I could sell at, let's say, 60K, right? Collect this premium. But one thing to keep in mind with Bybit is that this contract is cash settled. So the profit and loss is actually calculated in US dollar terms. Let's say I want to do a zero point 0.1 BTC short on the put option. So I'm selling some put options. And then as expiration, you can see that this is my profit level. I would be gaining $39.5 for the risk that I'm taking. But if prices dip all the way to 55K, you can see I'm losing 400 something dollars. But at that point in time, Bitcoin is cheaper. You want to just basically swap into that zero point 0.1 BTC or more at that point in time, right? The profit and loss is going to be equivalent as if you use that capital to buy BTC at 60K. So that's basically what cash settled is. It's actually settling your profit and loss in US dollar. You just gotta make sure that you do that extra step during expiration time to kind of swap into BTC if your goal is to buy BTC at this 60K mark. And if that's too much to manage, you could always use a option contract that is further out. You could sell put options that is really close, or a put option that is even in the money here at 67K. So that is something that we could do to earn additional yield on our capital. But you got to understand the risk, right? With put options, you have to be very comfortable with the underlying assets. And you can see a bunch of assets here that is on risk. There's stuff like Hype, Pump, Sol. You don't want to be like selling Sol put options if you don't plan to hold Sol, right? Because the worst case scenario in these instances is if the prices go down, you're going to be losing money, but then you would be able to buy these assets at a discounted price. So that is kind of the explanation with the put options. And there is a question about S Pendle as well. I haven't actually looked that much into it. I am staking my Pendle, but basically, what you're going to be able to earn now is just the Pendle fees that they generate. And they basically take the fees, the revenue that they earn, they buy back Pendle, and then they distribute it to S Pendle holders, right? But you gotta kind of claim on this as Pendle earning. I actually just staked my Pendle the other day. But basically, there's a staking 14 days cooldown. So if you unstake, you have to wait 14 days or you have to pay a 5% fee. And in my opinion, it is better than Pendle, where you have to lock up for like 2 years, I believe. And before it ended, the Pendle lockers actually got a boost for the S Pendle yield. So for the rest of people that did not lock, the yield would be a little bit lower. I'm not quite sure lower by how much, but it is going to be lower than like until these fee pendle eventually unlocks all the way. But for S pendle, again, it's just more flexibility. But the revenue for pendle also has been declining. I guess it is normal in like this type of market where people are less active, and it's just something to consider if you are trying to buy Pendle. You have to kind of compare like the tokenomics and the revenue that they generate. What I would do is hop to DeFi Llama and then go to Pendle. And then I could also look at the unlocks if I want, right? And Pendle's actually unlocked most of their funds already, and the rest is just incentives. We could roughly calculate the inflation rate per year. So right now it's February 19th. If I want to calculate that, I could go to February 19th. And then incentives is 30.7 M Pendle, right? And right now is 36.7 M. So about 6 million of Pendle is kind of hitting the market. I want to divide that by circulating supply. So 165.19. So it's about like 3.64% inflation per year. Not horrible, but That is like typically the model for these V tokenomics initially. And I guess with the buybacks, they would be buying the circulating supply as well, provided that they are generating revenue, right? But revenue in January has been pretty low. Again, I would expect that to be low when activity is low, but also because Pendle has that YT and PT thing, right? Where the PT earns a fixed yield, but then the YT gets the airdrop points. But the problem is, not a lot of people are gonna be really buying the YTs unless they expect the airdrop to be a pretty significant amount. And in a weak market, those airdrops tend to be pretty small because no one is gonna be like buying those coins that are getting airdrop compared to a bull market. Maybe people are just swinging left and right, and there's some manipulation going on with the altcoins. So then the YTs would be worth more, and then Pendle would naturally be collecting more and more revenue during those bullish period. So that is a risk for the revenue, and you can see annualized revenue about 10.2 million right now. About 80% of that, 8 million, goes to the holder. And then you can see the FDV here is around 335. So if we take 335 divided by 10.2, Pendle is trading at about 30 to 33 FDV to revenue right now, right? So it's not like exactly cheap, but the main concern would be like, are they able to grow their earnings over time? And then there's also that Boros trading platform where you could trade interest rate or hedge out your interest rate. And I believe the revenue switch for that platform is not on yet. So that is something to kind of look forward to. And this chart is really nice again to just kind of see where the earnings kind of flow. And I do believe again that the earnings is outpacing the incentives. So that is actually quite good. Right now, it's just not as pretty for the gross profit, right? And the last question that I want to go over before I hop off is rebalancing your LP when you're getting out of range. So this is always a decision that we have to make, especially if you guys are running a tighter range LP. So Liquid Philly here is asking if the min range is 70.9K and we are just grinding below it. Should I rebalance and widen the range a little bit or let it sit? If I list it and it goes back into range, will it perform exactly the same as before? So yes, it will perform exactly the same as before with the same impermanent loss and everything. So you're not really screwing yourself if it is inactive for a while, right? Some of my LPs have been inactive like for a few months now, and it doesn't really bother me because now we're just holding the spot tokens when the LP is out of range, right? And the main thing is we got to be comfortable with the spot token. With Bitcoin, you should be completely fine. And if you rebalance, would you use the technique in the latest video? You can actually do that where you're adding more USDC. That is a great option. But at the same time, if you're out of range already, you want to make sure you're moving up the upper range as well to make sure that you're not losing capital if prices bounce back, right? And on the other hand, he's okay with sitting BTC while it's out of range. You could use it as collateral on Aave if all else fails. So that is another great way. I call the strategy the bull lever, where you're using your assets like Bitcoin or ETH onto Aave, and then you're borrowing some USDC or some other assets against it to yield farm. That is another strategy that you could use. I am using that for one of my client portfolio. We borrowed against ETH and Bitcoin, and then we're yield farming ETH USDC in that 1 to 3K range that I showed you earlier in the video, right? So we are earning about like 20-30% APR on that capital, and we could use that capital to pay back the loan to kind of de-risk our capital. I typically tend to try to repay at least a portion of my loan. And if prices do trend up aggressively, I probably would take profit on those positions and go back to that BTC to USDC pool if you are running that, or into that ETH to USDC pool without leverage. That's also another way to do it, right? But basically, these are the four main options. You could use the fresh USDC we just talked about, the bull lever. You could do the expand and squeeze rebalance, but you want to make sure that you are simulating your rebalance before you do it. Or you could pivot to crypto LPs, but at that point in time, you are taking more risk, more altcoin risk. You're buying some ETH and you're buying some SOL. if you are picking those assets, right? Or if you're doing hype to UBTC, then you got to be comfortable with owning either one of those assets. So that is something to keep in mind. And this is a great point with Styles as well. He would add the USCC to rebalance the lower range and then DCA lower to farm the fees. And he actually made a great point where if your capital is mainly BTC to USCC, then the altcoin rotation strategy is probably not something that you should do if you're mainly comfortable with maybe just Bitcoin. And another great point, instead of using the bull lever, you could always borrow against your BTC to do some stablecoin farming. You could spread it out different protocols. There's some reinsurance protocols. There's different yield bearing assets that you could use. You could deposit some into HLP and you could use Pendle to farm these stable yield, right? But you gotta also make sure that you are kind of diversifying your stable yield. And some of those stable yield, it is much higher risk, in my opinion, than like just concentrated LPs as well. And if you want to do concentrated LPs, there's always that less risk strategy where we're setting the min range to 0. And then again, even if price drops by like 50% for ETH to USDC, you're only getting a 15% drawdown, right? So in my opinion, that's a pretty good risk and reward if you're worried about the downside and you're just pocketing that 10 to 15% yield on ETH to USDC, right? So you could always use these tools and these concepts apply for crypto to crypto pools as well. Hopefully, these concepts help you out, and hopefully, I answered a lot of these questions. And if you're inside of the Drippy community, thank you for your support. And if you're not, I would love to have you just use the code founding or the code VIP for the annual plans to get a early access discount. You're going to learn how to earn yield sustainably in DeFi. And one of the major difference that I try to do with Drippy is that I'm giving you the best information possible with all the risks and stuff like that. I'm not gonna like BS you about like, okay, you could earn like 50% yield on these assets without risk, and then with like really high success rate. Because again, the core idea behind investing a lot of times is that like the higher the yield, typically the higher the risk, right? And you're gonna have access to the tools that I just showed you. And then we're also developing some stuff like portfolio tracker. And there's like 100 something training videos that you could watch that we have. I am planning to update this sometime this year when some of the software is a bit more polished and we get that part handled first. And one more valuable thing, in my opinion, is just being able to ask me questions when you want, right? And then if you do the annual plan, there is a bonus for that as well. So this is live. You could go to our website at drippy.finance to sign up for it. There is a money back guarantee as well. And make sure you read all the things here. And if you have any questions, just leave them down below. I'll be more than happy to answer them. Thank you once again for watching. I'll catch you on the next one.